All right. So, hey, everybody, Dan Sam again, and I'm really excited to have two prominent investors, venture capitalists here today for the podcast. So we've got Ken Johnson, who has a storied history with Badger Fund of Funds and others, and he'll tell us in a second. And then Richelle Martin, who just recently raised a $10 million venture fund and has a really impressive background too. So Ken and Richelle, if you could just give a little bit about your backgrounds.
And I'll just give you a few minutes. I'm originally from Wisconsin, city of Oregon, Chemie from the University of Wisconsin-Madison. Worked in the oil and gas industry for 15 years, overseas, 10 different countries. Worked out of the London office for 3 years, 2 weeks out of every 2 months for 3 years of my life. I went to the kingdom. Saudi was a great buyer. Had some young children, wanted to get back to Wisconsin. By stroke of luck, I joined Wisconsin Alumni Research Foundation, patent and license organization for intellectual property from the University of Wisconsin-Madison, my school. I spent 8 years there. I represented WARF in the first 15 spinouts back in 92, 93, 94. That was new and novel. My licenses generated about $500 million of royalty income for the university. Again, stroke of luck, I wasn't looking for a job. An investment bank in Manhattan who's providing services to one of my portfolio companies offered me a job working in private equity financing for university spinouts for 3 years. I lived half of my life in Manhattan. We did about 10 different companies, raised $50 to $100 million. 3 of those companies went public on the NASDAQ. Remember, I was a very minor role, but I had options. I did make money on this arrangement. My daughters had gotten older, teenagers. I was tired of traveling back and forth. So I decided, like most people, what I'd say as a Madison entrepreneur, I was unemployed and want to live in Madison. And so let's start a company. That is the best way to live in Madison. So I started up and was the entrepreneur on 8 different companies. 3 of those, I was lucky enough to have acquisition. My pig ingredient company was acquired for $8 million. Was in a company that manufacture high potency drugs. Tetrayonics, it's now Sigma Aldrich, employs 500 people. We sold for $56 million. And then I was a founder on a company that did health products. And if you go to GNC, the Tonal and Absorbitol are still sold there today. We went public for $80 million. So I had these 3 successes, all entrepreneurial. And basically my job was to raise money. I was out raising money because no one liked to do that. And after you have you try it for, well, it's actually kind of fun. So I thought, would it not be better just to have all the money and just be an investor? So that would be venture capital. I went out and started my first fund in 2005. I have 37 investors. I put in $500,000, and like many of the entrepreneurs we'll talk to, my uncle put in $1 million. My 2 cousins put $250 either. So of my $10 million, 20% was family. I invested in 13 different companies over 15 years. 7 of those, like in most businesses, I lost all my money, somewhere between $500,000 and $1 million. 6 of those companies have been successful. I've sold 5, generated about a 3x return or 18 to 20% annual return. I have 1 company left, has $30 million of SaaS revenue out in DC. So now I was about 60, the kids are gone, I had time. And I decided that I would like to start up 5 or 6 venture funds, just like Keegan's in Wisconsin. I was going to sprinkle them around the infield, and we'd all do the same money for Winnow strategy, which is the first $500,000 into brand new companies, because that's all I knew about. I partnered up with Sun Mountain. They're in New Mexico. They had done 8 fund of funds previously, so they gave me some more national experience. I had the Wisconsin experience, and we started to raise money, and life was good. And then the state of Wisconsin, the government, in their infinite and all-willing knowledge, decided they would put $25 million in venture capital. I mean, I have no reason why they would do this, but that was their plan. And so we stopped fundraising and applied for their $25 million. It took a couple of years in a competitive bid process with Credit Suisse. We were selected to be the manager of the Badger Fund of Funds. I raised $10 million more, so I have $35 million with Sun Mountain to invest. We have started 5 new funds, of which the Winnow Fund and Richelle is one of them. We put in our $25 million. They raised another $50 million, so we have $75 million of assets under management. We have 5 different funds, one in Fox Valley, one on the west side of the state in La Crosse. We have one in Madison, one in Milwaukee, and then Richelle's a little different. She doesn't have a target geography. She's focusing on entrepreneurs in the college and university environment.
Okay.
We've invested in 36 companies. Our goal is 70. We invest in a brand new company about once every 2 months now, and we make a follow-on investment about once a month. So we're aggressively investing on the low end, $100,000 to $200,000 in a brand new company just starting. Our high end, Rock River has done a couple rounds of $5 million plus. When Rock River syndicates with some other funds, we have about 10 to 12 out-of-state funds that have syndicated invest in our companies. So we're definitely looking for deal flow, entrepreneurs that want to stay in Wisconsin and are looking for money.
Okay. Well, hopefully some of that deal flow is going to be listening to this video, I hope.
So,
Yeah. A lot of people ask me, how do you get into venture capital? All you got to do is do all the stuff Ken just did. If you prove yourself the way Ken did, you're in.
I've only been doing this for 3 years, so mine's going to be a lot shorter.
Yeah. Well, yeah, Richelle, why don't you share a little bit about your background? Because you're kind of, the buzz is you're kind of a rising star in the venture community in Wisconsin. So share a little bit about how you got to where you are.
Whoever you're talking to, I appreciate that. I'm also from Wisconsin. I was born in Franklin, born and raised, grew up in the Milwaukee area. It's a suburb of Milwaukee. Did my undergrad at UW Milwaukee and art history, political science, and psychology. After that, I decided I was going to go to law school. So I ended up in Madison, did law school here. My first, foray into the entrepreneurial world. I was a student attorney in the Law Entrepreneurship Clinic, working with startups. Thought it was fantastic. The energy, the excitement, how fast-paced it was, I loved it. Unfortunately, when I graduated, I couldn't just go into being an entrepreneurial startup where I worked at a small firm for a little bit, hated it. So 3 years of law school, 11 months in a firm, decided I wanted to do something else. I found a job at UW-Madison where I was working as part of the research enterprise, negotiating contracts at the intersection of industry and innovation on campus. So big companies, GE Medical, Ford, Monsanto wanted to come in, sponsor research on campus. I made sure that all the expectations were settled and that the funding came in and that the companies got what they wanted. Part of that was making sure that intellectual property was appropriately handled. And through that, I started working with a lot of innovative faculty members on campus. At just about the time I was getting really frustrated with the bureaucracy of UW, I ran into Ken. I was volunteering at an event called Jazz at 5. I was serving beer in a beer tent, handed a beer to Ken. Right place, right time. Yep. We got to talking and, I expressed my background to him and some of the frustrations I had at UW kind of aligned with some of the things that he was trying to solve through his efforts at Badger Fund of Funds. So Ken convinced me to quit my, lovely job.
Didn't take a lot.
Yeah.
Didn't take a lot, Dan.
I had, great job, great benefits, but somehow the frustration kind of outweighed that. Ken gave me a solution to all the things that I was kind of running into. And so I raised the Winnow Fund. It took me about 2.5 years to do that. And so we started actively investing in 2021. Since then, have made 2 investments and are working on a third. As Ken mentioned, one of our core focus areas for deal flow is finding good investment opportunities on the colleges and universities all across campus. I know that they're out there. I've ran into really great faculty members and students and staff at these universities. And I think part of the problem is translating what they're doing on campus into the commercial markets. So our goal is to help some of these, inventors, these entrepreneurs make that jump.
Great. Yeah. So you've entered the low stress world of venture capital.
Yeah, I went from being a super risk averse lawyer to being a very risk tolerant investor.
Yeah, I'm sure it's pretty high stress, but it's probably rewarding. So a lot of the people listening, I think, not all of them, but many are going to be connected to a university. So I think they'll be curious for you to kind of coach them a little bit in terms of what venture capitalists are looking for both of you. I mean, in the broader sense, maybe half of the people are not going to be connected to universities, but the other half are. So I don't know, both Ken and Richelle, can you talk about what you are looking for in a good investment generally, and if there's anything kind of unique to dealing with university connected companies?
I think generally, I'll let Richelle do universities. I'll do the general because that's really where I'm at. So the way I look at it, there's 3 different components. One component is the management. Mm-hmm. One component is the return, and one component is the product. Mm-hmm. So that's the 3 key components of an investment decision. So the first component that we look at, all venture capital, because I have investors, so is return, return, return. So 19% of the investment decision is if the entrepreneur's business plan, remember the entrepreneurs, I've been one, I've started 8 companies, 5 failed, 3 hits. We're optimistic. If we're not optimistic, we are not an entrepreneur. entrepreneur. So for sure, whatever their plan is, it is the best it could possibly happen. So if we look at the return and we cannot make the national average return, remember, it's just like, I assume we all know the Dow Jones, we know the Russell 2000. Every day they put the return. So Cambridge, there's a number of places that do the national average return of venture capital. You can only get it every single day. The difference is if you go to the Dow, very few companies go out of business. And in venture capital, over half the companies you invest in, you're going to lose all your money. So you have to take into consideration that the company that's going to be the winner has to cover all the losers.
Right.
So if the national average is 20%, which is about what it is now, most of us that are investing in a brand new startup are going to need 100%. We're going to double our money every year. This is just a kind of a rule of thumb. And so I'm looking at the return, and some people are optimistic. So then what we also have is we have about 10 to 15 standard practices in the industry. And the one I always use is most of the people have bought or looked at houses. You go out and purchase your own house, you go to the bank, and the only thing they really look at is the principal, interest, taxes, insurance. Is that more or less than 32% of your gross income? Now, how they came up with it, I don't know, but that is a standard practice. If you're 35, they're not going to lend you the money. If it's 25, they might do it. So we have a number of those. So we would look through your game plan, and if it's way outside the standard practices within the industry, boy, we'll start talking about how the Cubs are doing and how's that Aaron Rodgers contract. Geez, it's over for you.
Yeah.
Out of every 20 ones that I see, there may be one, if the plan was implemented perfectly, would actually make the national average return that I'm looking for, or Richelle's looking for, or any venture capital fund is working for. So once you've made the return one, the next thing I look at, the 80% of the investment decision is management. In other words, we talked about return, which is like analytical, it's an Excel spreadsheet, it's all numbers. Management's all emotional. Whoever that entrepreneur team is, I'm going to be working with them for the next 5 to 12 years of my life. We're going to go up and down together. We're going to raise money together. We're going to have all kinds of decisions. Will we work together in a team-like environment when it's going to be stress all over the place? The second is 80% of all startups go out of business because they run out of money. So if you come to me and say, Ken, I'm going to do a $100 million company. The national average needs $20 million to start up a $100 million company. I'm going to look Sally in the eye and say, do I really think she can raise $20 million? Because if the answer is no, I'm not going to invest. So I have to look at the plan, the profile, the national average, and mostly say, does this person have what it takes? Mm-hmm. And about 1 out of 5 times that I've invested, I've told Steve or Sally, listen, I like your idea. You've got the return, but I don't think you can do the job. Would you mind if I bring in a different top person? And you can have your stock ownership. Sometimes it does. Sometimes they hate me and leave, and sometimes they say, okay. So let's just say we get done with the management portion, and you and I and everyone thinks the team has it. 1% of the investment decision is the product. So I tell all entrepreneurs, when you do your pitch, your presentation, your 2-minute, whatever they call it now, 1% of your time should be about the product. 1%. So if it's a 2-minute pitch, that's about 10 seconds. Yeah, I'd like to know what it is, but I really don't care. They should be spending all of their time saying, venture capitalists, if you invest $3.5 million with me, I think in 3 to 4 years, I'm going to sell for $35 million and you're going to get back $11.5 million. I'm going to raise this much. I have 5 investors already in on it. And pretty soon I'm going to say, geez, Dan, what product do you have? And that's when you say, Ken, I just can't tell you. Oh, I got to see in person the presentation. So what you're trying to do is bring the investor to the return well, convince them that you got return. And when they start to know start asking questions about the product, that's when you say, you got to see my investor presentation.
Right.
You got to move to the next step. No investor is going to invest in any company without you seeing them in person and doing an investor presentation. So the more information you give before the investor presentation, the more likely is they're going to turn you down without seeing your investor presentation. So another tip for all entrepreneurs is slim down those executive summaries. Don't give them all the information they need to make a decision, because it's going to be no. The only thing an executive summary is for is to get you to the presentation.
Right.
So tell them return, return, return. I can do the job. I've done these startups. I can raise this amount of money. I know all these investor buddies of mine, and 1 or 2 sentences about the product, and do your presentation, and then really sell them on your idea.
Okay. Well, I was going to ask you what makes for a good presentation, but you just told us that. And it's sort of the reverse of what people usually do, which is they tell you all about their technology, and if you're lucky, they throw in a slide about the financials at the end. You're looking for the opposite.
That's what the people in Wisconsin do. Please make that geographically specific, okay? If you go to California, and I'll have an entrepreneur, they say, gee, this is a comparable in California. We're doing almost the same thing. Their valuations, this, that, and the other thing. So, okay, let's take a look. So what's the first thing I look at? Do I look at the product? No. I go to the CEO and say, how many companies has that person sold? I go like, oh boy, been in 5 startups, sold 3, raised $100 million.
Yeah.
Remember, Aaron Rodgers gets paid 10 times more than Jordan Love because he's experienced a lot more experience and success. So remember, when we look at an entrepreneur and we're doing comparables of companies, the most important comparable is not the product, it's not the dollar, it's not the geography, it's the experience of the entrepreneur.
Okay.
So if the entrepreneur of the one out in California has done 3 companies and sold 2, and you want the same valuation, that means you have to have it done 3 companies and sold 2.
Good point.
Yeah.
Okay. Well, Richelle, do you want to add anything? And could you also give sort of a version of what Ken just did that could be helpful for people that are in a university? I mean, one thing that comes to mind right away is they're not going to be CEO if they're university connected, but any kind of advice to add to what Ken said for those that are connected to universities or outside for that matter.
Yeah, one of the most important things Ken said is that when you're looking at who's going to be a potential CEO, one of the best indicators of success is that level of experience that they have.
Right.
And so to decrease, the risk that investors are taking, they are going to look specifically at people that have some experience in that area. So one of the things we expect to do is if we find a good investment opportunity on a campus, we may look at installing a new CEO to lead that company as it scales. And a lot of times I think that that's going to be very compatible with what these inventors on campus are looking to do anyway, because what I've seen is that these good innovators usually are some tenured faculty members who aren't looking at leaving their job, or it might be a student who already has a job offer after they graduate. They're not looking to risk that all on a 50-50 startup opportunity. And so I think we will find people that are a good fit for what the Winnow Fund is trying to do. Another thing that I want to touch on that Ken said is this process of presenting your information to an investor. What an entrepreneur should do is work backwards. So they should go through that whole business plan, have it all well thought out, answer all the questions that need to be answered to create that business plan. Then they're going to boil that down into their presentation, their investor presentation, then further boil that down into the executive summary. So you do not have to have all of the information that you could possibly cram into that executive summary. When Ken says 1 or 2 pages, we really mean 1 or 2 pages. If it's more than that, I'm going to lose interest. I'm going to make a decision that's probably going to be no, and we're never going to get to that next step. But so entrepreneurs should work backwards when they are putting that information together. And then when you meet an investor, you go back through those steps. But an investor's never going to want to see your business plan. We just want to know that you've thought it out. And it's going to come through in the questions we ask you and the answers that you have, whether you've gone through the exercise of putting that business plan together.
So you're not saying to skip the business plan, you're just saying to show them the summary of all of that. And the business plan is more a way for you to think through.
Yeah, I don't think that you will have a good investor presentation or a good executive summary unless you have a good business plan.
Okay.
And so just to build a little bit on what Richelle says, remember, we're emotional. We're going to work with you for 5 to 12 years. We're going to raise $20 million. I want to know more about your personal life, your love life, and than you ever can imagine, because it's going to affect everything we do. So if I come to you and say, please give me a 1 or 2 page executive summary, and you give me 3, I'm going to think, am I going to spend the next 7 years of my life with this person? Every time I ask for 1 to 2, I get 3.
Yeah.
Remember, every single step of the way, from the first time that you talked to me about being an entrepreneur and I'm writing a check, my mind is thinking do I want to work with this person for 5 to 12 years? And so I say, I like Times Roman font, 11, 1-inch margin. They think that's ridiculous. They give me Arial 10 with 1/2-inch margin. I think, oh man, am I going to spend the next 7 years of my life with this person deciding what they think is better for me? So remember, the subtlest, lowest, every time they're doing something, we don't have a lot of interpersonal interaction time. And so we know they're going to be on their best behavior with me. We know they're going to give us their shiniest, greatest, enthusiastic presentation. So it's all the other things we're watching all the time. Are they working on their, when I'm talking, are they taking a little thing on their iPhone? Are they taking calls while they're talking to me? I'm like, man, if I can't even get 10 minutes of their prime time when they're trying to get money from me, they're never going to be listening to me when things are really bad.
Yeah.
So they've got to look, I think more in Wisconsin are lost on the emotional side than on the other one. We're looking at them, and remember, 5 to 12 years I'm working with you, Dan. Are we going to be buddies for 12 years? Or, at somewhere in year 6, I'm going to pull out the little hair I got left and like, you're out, right?
There's always
Just so you know, Ken, I was writing notes when I looked away. Wasn't looking at my iPhone. Richelle, you gonna say something?
No, there's always more deal flow than dollars.
Yeah.
So if we're asking for, specific things from a company and they're not giving it to us, someone else is going to give it to us. So if someone else is going to make it easier for us to come to a decision about whether or not we want to make an investment, we're going to want to work with that person versus the person who's kind of pushing back on some of the little.
Oh yeah. I mean, I don't have anywhere near the experience of the two of you, but when I was raising venture capital, we jumped when the venture capitalists told us to. If they said we'd like your executive summary, we would get it, within the next day. It's not like, oh, I'm sorry, I forgot to get to that. Well, now you're out of the running for sure.
But you can ask that. So if you would say, I've got 2 children and I've got daycare and this, could I get it in day 4?
Yeah.
I'm always going to say yes. But then when it shows up in day 5,
yeah, something there.
that's right. And if it shows up in day 3, I'm like, wow, well, this person really delivers.
Excited.
So what about, and you touched on this, Richelle, and Ken, you talked about how important the CEO is. The challenge that a university spin out has. I mean, so it's probably not going to be the professor, even if they quit their job. Sometimes it's oftentimes a student that wants to be it. Is that even viable? Or what is the solution to the CEO problem for university spinouts? So is it always, you finding them somebody, or do you ever look at a young up and rising person?
I think the way it's just, we step away from venture capital and just look at business as a whole.
Yeah.
You're in a business organization, university business organization. How many of the people in your managing organization stay in the same position for 10 years? Typically the ones that are the losers, because the ones that are good are moving up, right? Remember, we're exactly the same. And so that every entrepreneur, I know we know Bill Gates ran his company forever. I got it, maybe Zuckerberg too, I don't know. But in general, it's just like any other business organization. As the company grows and different skill sets are needed, we're going to bring in different people. So one of the things we have to judge with the person we're going with 5 to 12 years, is Sally interested in this job because she wants to be a CEO in top cheese? I'm not interested. Is Sally in this because she wants to make a lot of money? That's what I want to do. Okay, I'm going like, I think Sally wants to make a lot of money. So I'm going to invest in that Sally. Okay. So that, remember, again, it goes back to the basic tenet that with the entrepreneur, our interests aligned. So the interest I want from my entrepreneur is only one. We're going to make a lot of money and we're going to make it soon. Mm-hmm. Anything else? So they talk about how they want to be the CEO for the while. They're interested in hiring people. The professor says, I want to see how the public is going to, I think my technology is going to cure cancer. And I'm going like, this does not interest me. What interests me is, I think if we started up on Monday, we can sell it in 6 months for $10 million. I'm like, oh boy, this talking my language. So again, we're making all the little indications. And I think too many times the entrepreneur makes it, in my mind, that it's more important to he or she that they be this great CEO, they be the top person, they hire and fire and whatever. And all I want them to say is, how am I going to take my 60% of my stock and make it worth a lot of money?
Sure.
Same thing I want to do, isn't it?
Yeah.
So my favorite entrepreneur is always Brian Wigan, because we invest on Monday, we send him the check on Wednesday, and by the end of the month, he's already talking about his next company. As soon as I sell this one, Ken, I got another great idea. And I'm like, okay, that's what I like to hear. So what do you say?
Anything else?
Many of the people in the university sector are much more attuned about being the boss than making money.
Well, and they're not going to invest in someone who wants to hold on to the company forever. They can't have that emotional attachment to it. So his Brian Wiggin example is perfect because we want someone who understands that we all only make money if that company exits.
Yeah.
And sometimes it takes a different person to build a product than to build a company. So if you might be the CEO coming in, you might be the person who's most passionate about that product, but there may come a point where it becomes more about growing, scaling, and exiting than it does about building that product.
Right. And unlikely to be that same person. And as I've heard you and others say, it's much better to have a small piece of a big pie than a big piece of nothing.
Exactly.
Yeah. Remember, we can't, in general, a venture capital can't sell their company unless the CEO is all for it.
Yeah.
He or she, that CEO is our primary salesperson to get this thing done. I get my money back. So we get somebody in there that's, well, geez, I'm making $500,000 a year. I'm 31. I got this great company and I got all these things. I'm loving it. And if I sell this, I get $3 million, but I'm out of a job. I'm 33 and I don't have a job. I just got $3 million. I'm like, Steve, we're selling the company. But if he doesn't want to, it is really difficult.
Right.
We're making that judgment for the first time we see him until the moment we write our first check. Because once we write our first check, we're in.
Yeah. That's good advice for all entrepreneurs to be aware of. Everything they're doing is being watched because the person and the personality is so important to this. So
because everyone, by the time it gets even remotely close to writing a check, every executive summary is fantastic.
Yeah.
Every presentation kicks ass. All the market sizes are $1 billion, and they've got 4 comps that are similar to Uber, so they're all the same.
Yeah.
Okay. So the decision-making process is based on other things that we think. The other side of the component is the risk side. So the risk side of the component is we know we're going to lose 50% of the time, but all the ones we invest in, we think are going to succeed. And that the component of success is the personality and the willingness of the entrepreneur to do whatever it takes to get the job done, which could be leave the company, could be bringing a different CEO. It could be a bunch of different things, all of them very emotionally difficult for them. Not very many. For me, all I'm doing is writing checks, right?
Yeah.
But one thing I do want to clarify though is Ken and I have both invested in first-time founders. So we're not saying that that's the only indicator of success that we look at. So a lot of the other things that Ken has mentioned are also really important to us. So do we think this person can fundraise? If I see someone who has never had a company before, but I think that they're going to be a fantastic fundraiser, that's going to tilt me in their direction because fundraising is one of the hardest things that they're going to do. So it's not to say that you should only be leading a company if you've done it before, because I'm a first-time fund manager, and that was a problem I ran into. Is a lot of people said that they wanted to invest in people with a track record, and I said, how can anyone become a venture capitalist if they've always had to raise a fund before they can become a venture capitalist? And so we're very aware of that.
That's true. If everybody's got to do it 4 times, then how did you do the first times?
That's right.
All right.
And then I'm sure all of us, we all watched these where they do personality types.
Yeah.
They do judgmental, and there's this false impression in the marketplace that the successful entrepreneur is gregarious, extrovert, everyone likes them.
Mm-hmm.
Look at all the best, the winners. I mean, is there any big winner than Stephen Jobs? There is not. All the biggest winners tend to be introverted. They are very judgmental, my way or the highway. Me too. So I have that same technique, right? I might say it, but so when you look at it, So when you look at it, the personality type thing. Remember, when I say all these things about the entrepreneur, we want the judgmental. We're betting on their judgment.
Yeah.
Do we like singular focus? You bet. I want them singularly focused on selling this company. Passion, again, a very much an emotional word. If you talk about an investor, the thing we like the most in our entrepreneur is passion.
Yeah.
I mean, they are talking, I'm sure we've all heard the story of Bill Gates crawling over tables when someone said Microsoft wasn't the best thing on earth. When IBM signed the secrecy agreement and IBM got all the information they had to, and everything they told Microsoft had to keep secret. And all the Microsoft IBM did, what did he say? Those guys suck. Don't worry, we're going to crush them. He did. He's passionate about his product. So that the personality types, I think, at least I've learned, some of the more quiet, judgmental ones that don't work in an organization very well because of those type of techniques actually are great entrepreneurs.
Okay.
Really, they're on it.
So maybe the difficult rogue professor could be an entrepreneur.
Absolutely.
All right.
Because they're passionate.
Well, on that
about-
positive note, for all our
They're
difficult rogue
passionate.
professors.
You know some of those, Dan?
Oh, yeah. Well, I'm one of those, but I'm not sure I'd be a good CEO. All right. Well, thanks, Ken. Thanks, Richelle. Really appreciate it.
Okay,
Yeah,
thank you.
no
It's
problem.
very
Thank you.
enjoyable. Hope to see a few new deals coming our way from the universities.
Sure.